Welcome to Peerpoint Perspectives, the Securities Finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Peerpoint Perspectives is brought to you by the consulting team at Peerpoint Financial. So now, over to your hosts.
Hello and welcome to Season 2, Episode 6 of Peerpoint Perspectives, the art of securities finance. I'm your host, Roy Zimmerhansl, and practice lead at Peerpoint. Before I get into this week's episode, I want to let everyone know that from Wednesday, the 2nd of December, we'll be hosting an event each week on LinkedIn Live and possibly other channels. Of course, this episode is going out the day after that, so hopefully you joined us yesterday, and if not, we hope you'll be able to participate next Wednesday. So look for details in the show notes. Now, I've often said that securities finance is part of the entire fabric of the financial markets, and that if you look deeply enough, you can often find a link between financial news stories and securities finance somewhere. The most obvious place is in capital markets activity and mergers and acquisitions. So I thought it might be interesting for listeners to hear from a well-known and highly respected financial journalist who's been covering these areas for more than 15 years. Lucinda Guthrie is executive editor for Acuris Equities and Transactions Division. She leads the global editorial teams of more than 200 journalists for 6 products, including Merger Market, Deal Reporter, and Par Global. During her time at Acuris, Lucinda launched the group's equity capital markets content, as well as a platform focused on shareholder activist strategies. She has written and edited content on some of the biggest M&A deals, both pre and post-financial crisis. She's a frequent media commentator, and I'm absolutely delighted that Lucinda has taken the time to be with us today. Hello, Lucinda. Good morning, and thanks for joining us today.
Hi, Roy. Thanks for having me.
So, listen, Lucinda, I know we've worked together a couple of times. You've been a featured speaker at events that I've done, so I appreciate you taking time out. Securities finance markets are really part of the wider capital market. So from my point of view, it's really valuable to get some kind of a view on what's happening beyond the normal secondary market trading that we see day to day. So you've been covering these markets for more than 15 years. Look, I'm really interested in hearing what you have to say. But before we get started with that, why don't you tell me about Acuris and what you do there?
Sure. Well, Acuris is a financial intelligence and data company, and we have products that will be familiar to a number of your readers, like Deal Reporter, Debtwire, Merger Market, and we really focus on niche financial information. So my team, I cover the Equities and Transactions division, and my team cover everything from forward-looking M&A to looking at what equity capital markets transactions are coming down the line. And we have journalists in each key financial market globally. And one of the things that I think that really sets us apart is we ask the questions that everybody else doesn't. So we end up with fantastic forward-looking information. So hopefully I can give you a bit of an insight about what's happened this year, but then also a little bit of outlook about what we expect to come.
Well, that's terrific. That's exactly what I was hoping you would say. So thanks for that. Look, 2020 has been a crazy year just about any way you look at that. And has that also been reflected in the markets that you cover?
It's been an absolute roller coaster. Looking at M&A particularly, we started the year in Q1. Everyone was expecting this fantastic year for M&A. And, we were out the blocks with the ThyssenKrupp Elevators deal, which was a huge private equity transaction. And then suddenly, obviously, COVID hit and we all went home and companies were just stopped everything. There was a complete paralysis of activity where everyone was just looking at, can I get through this? Do I need to raise capital? Is my business in good shape? Private equity firms, there was this huge furore at the beginning of the year about all the dry powder that private equity firms had. But they had to look at, well, how am I going to look after my portfolio? And my portfolio company is going to get through this. The second quarter was complete paralysis. The financing markets, also just the worst market we'd seen. Nothing was getting done. And then as people got used to the world, we started to see deal flow coming back. Deal makers became more comfortable with the logistics of the pandemic. Before this period, no one would have thought of doing a deal entirely on Zoom calls. And now that's not such a foreign idea. Things are actually, getting out the door. What we really started to see, though, in Q3 was the pause deals starting to come back. But it wasn't for everything. It was a real bifurcated market. You have those deals that people were comfortable with, that weren't impacted by the pandemic, and deal makers felt comfortable with those. But then at the other end of the spectrum, you've got really distressed M&A that had to get done. The impact on the stats was that the third quarter was really a tidal wave of M&A. To give you an idea, overall over the first three quarters, M&A was down 28% in deal value globally in the first three quarters. Just digging into that, US M&A in the second quarter declined by 65% by value, and then it rebounded in the third quarter. It was up 400% in the third quarter. It's just amazing. And for Europe was down 20.7% over the first three quarters. But the rebound in Europe was up 54% in the third quarter, based on where we were from the second. So you just saw this huge volume of huge deals coming through, and they were the larger transactions as well. And as I say, it was some of these deals that were really paused and that people felt comfortable with, and then it was also the deals that people understood were almost kind of COVID proof, that started to come back.
So that's one of the things I wanted to ask you about. Are the deals focused on industries that, as you say, are kind of pandemic proof, the ones that have actually survived well, continue to thrive, and they're just good, sound businesses, and that's what people are interested in? Or has there been kind of bottom fishing and looking for the desperate companies that are looking for a way out?
Well, there's a bit of both. I mean, tellingly, obviously, technology, that sector, is up 12% in the first three quarters, based on from last year. So technology sector, everyone knows that's going to be huge. But we are seeing some bottom fishing as well, or at least perceived bottom fishing. So you've got in the market now, there's a care home deal for McCarthy and Stone, and there's some noise around that from shareholders because it's seen as a kind of opportunistic bid, because UK care homes obviously have had a very difficult year, and then on the flip side you have the kind of $38 billion Nvidia ARM combination. ARM holdings make the chips for your mobile phone. So I think, as you say, it's those two kind of strands of activity that are pushing things on, but it does look very different. And I would add that now the deals are getting done where lenders feel comfortable with kind of sustainable, durable cash flows as a general rule.
Right. So a bit of a buyer's market in that case.
Absolutely.
Yeah, it's interesting. You talk about statistics, and I think that's a great example. I often talk about in the way the statistics work, that if you have one foot in a bucket of ice and another foot in boiling water, on average you're okay, but that doesn't really tell the story behind it, right?
Yeah, exactly. And I do think that this is going to continue into next year as well. Um, the trends that we're seeing.
So do actually do you see that these big deals? Because often you see that a lot of M&A activity is companies are emboldened when stock market prices continually are rising, and they can use their share price as part of it. Are a lot of these stock driven deals, or are they cash deals, or combos, or how does that compare now to the past?
Well, I think the interesting thing this year in Europe, particularly, is people are structuring transactions increasingly to factor in the fact that this year's earnings are, an anomaly, and does Q2, Q3 of this year reflect what you're going to do in 2021, 2022? So you're seeing more kind of contingent value rights as a part of the transaction. You're seeing more interesting structures so that people can put, put a piece of the deal there that isn't just like, look, this is 2020, this is what we've done this year. They can recognize what the actual value of the company is, rather than just how we've done this year. So I think, we are seeing more different structures, and there are mixtures of cash and script. One thing I would say is that one banker I was speaking to recently is just saying, at the moment, this is the most attractive debt market we've had in the history of modern finance, because the cost of capital is the lowest we've seen, and that's right now. So I thought that was quite interesting.
Yeah, I mean, who could have predicted the way these markets were going, right? In sort of 2016, 2017, when I was running an agency lending program, I was trying to get more corporate bonds into my lending program, because my view at the time was, well, a lot of these are coming up for refinancing in 2019, 2020. And surely the markets will be better. We'll start having normal interest rates again. And a lot of these zombie companies that were able to get cheap financing in the past would be confronted with different sort of pricing levels and not be able to refinance, and that would lead to some restructuring there. Yeah, who would have thought that we'd be in possibly even lower interest rate environment?
Yeah, exactly. I mean, that quote actually was from a few weeks ago. It was pre-election. I should qualify that, because obviously the markets have shifted again, as they do this year. And the thing that's interesting as well this year is thinking about how corporates have started viewing the equity market as a means of capital. The last few years, I got the feeling, just when you look at the numbers, that corporates, there was a big shift towards, going private. People were not favouring the public equity markets as much. Whereas this year, it really felt, certainly in the UK and in the US, that corporates started to appreciate the equity capital markets again. It's almost like, you could breathe life back in to the company through capital raises in this market. Like in the UK, there was the FCA increased the amount of capital you can raise without that preemption rights, a cash box, to 20% from 10% for the kind of COVID period. And you did see people take advantage of that. And certainly in the US as well, you saw people taking advantage of the equity markets, both offensively and defensively, during this time. So I feel like that was something, there was a real positive for the equity markets this year.
Yeah, I
Yeah,
mean, if you look back in your career, I mean, the number of stocks that have disappeared from exchanges in that 15-year period is huge, right?
exactly. So it was good to see this year, some ABBs coming. Obviously there's big transactions like the Rolls-Royce rights issue. It was good to see those companies, and then also to see in the US more of a kind of glide from the private to the public markets as people get more comfortable with kind of direct listings, and then you see SPACs. This year was definitely a good year for the equity capital market. So that was good to see, and I hope that continues.
Yeah, one of the sidelines that I've had a few private conversations with people is that in a year where so many people have been in such personal distress, some of these banks have actually made huge bumper profits from some of these transactions. Again, not necessarily Q2, but Q3 and sort of the averaging out of some of these statistics means that there is going to be a huge amount of income, which is going to maybe sit uncomfortably with some people.
Yeah, I mean, just the size of the transactions. I mentioned the multi-billion-dollar deals earlier. There were 32 deals over $5 billion globally in the third quarter, and the fees on a $5 billion deal will not be will not be sniffed at, I'm sure. So yeah, it's I think, yeah, there's always people who make money in a crisis, and I think that there will be some hefty fees. But that said, overall, certainly on the M&A side, although we had this really kind of thumping third quarter, it still was, overall where we are in the year, we're still quite a way off where we were last year. So
Yeah, it's one of those things where if a market drops 50% and then goes up 50% from that point, you're still behind where you started, right?
yeah, exactly. So it was, an exciting third quarter, but I don't know. Yeah, I'm not sure whether the bankers' fee story will be huge this year.
Right. And what do we normally see in a typical Q4? A lot of activity, a little activity, people trying to get things done before the year end, or people saying, we're too close to the year end to get anything meaningful off.
Yeah, usually this is one of the busiest times of the year. Normally Q4 is absolutely, we're rushed off our feet. The interesting, and I am hearing this year from people that they are anticipating a busy 2021, and people are busy right now. But there are some concerns around macro issues, political issues that are coming down the track. Obviously, at the minute, in the UK, you've got Brexit. We're bored of talking about Brexit, I know, but we still don't know what that looks like today. We might in a few weeks know a bit more.
Personally, I'm never tired about Brexit because I love change, right? Change. I always find change is really interesting, and it's what keeps me waking up in the morning to see what's actually going to be changing today. So I might possibly be the only person on the planet not bored of Brexit, but I'm happy to be in that position. So, but obviously, with the changes, that must change companies' attitudes for transactions.
Well, I think it does. I was talking to a US advisor recently about their appetite for cross-border M&A. Now, with Brexit in particular, and they were saying, well, for us, it doesn't make a huge amount of difference. depending on, obviously they have to assess the company's exposure to contracts with Europe and what the individual company's dependencies are. But they were saying they would always feel more comfortable with the UK company anyway, and they saw it as an opportunity for bottom fishing, to get some cut price bargains for their clients. So there's that angle. Equally, in terms of the changes, I think there are some corporates already that are a little concerned about what the regulatory impact will be. I mean, just looking at your execution risk on a transaction, when you think about what's going to happen post Brexit, just if you're doing a complicated deal. At the minute, you can file with the European Commission if it reaches certain thresholds, and you wouldn't have to double file with the UK CMA. Whereas obviously after, depending on what a deal looks like, but highly likely from January, you will have to file with the EC and the UK. You face an investigation with the UK. And I think people are already people have been concerned about this since the beginning of the year, about how, because of the UK's voluntary system, you could end up with a real time lag on your transaction, because it's a little bit like MOFCOM. I should cast your mind back when the Chinese Ministry of Commerce was called MOFCOM back in, 2008, where MOFCOM was almost seen as a kind of black box. Now people see that more with the CMA, because they feel that there's this kind of voluntary system. They're not sure when they have to file, when they don't have to file, and they also feel that because the CMA in its recent consultation noted that where there's these big international transactions, they might wait for other jurisdictions to see what remedies they might put onto the transaction, what their requirements might be to get the deal through. The CMA might wait and then later open an investigation, and all of a sudden there's this huge time lag on your transaction. You think it's going to take 9 months, and then suddenly you have another competition regulator on the end. I mean, that is something that people are very concerned about in terms of Brexit on the corporate side.
That must be a huge issue, right? Because as you say, it's that execution risk that's probably the biggest uncertainty when you go into large transactions, and it's about time and it's about effort. So to have a concern about something new on top of it, because the UK has always been very welcoming of inward money in that sense, and it's never really been much of a barrier. And now if there's the potential for that to happen, not only for another layer of investigation, but for a delayed layer, that's got to be a huge departure.
Well, that's it. And that's just on the competition side, because you just mentioned, foreign investment. Up to now, the CMA was also looking at the foreign investment piece. But the UK government has recently issued another consultation on a potential new unit that would assess foreign investment, and these would be a kind of mandatory filing where they would be looking at 17 sectors, and they're not just the sectors you would think about, nor typically for foreign investment, like defence or critical suppliers to government, but they're also looking at things like artificial intelligence, cryptographic authentication, satellite, and you get the feeling, that through the consultation, hopefully they'll narrow these sectors down. But all of a sudden, when you're looking at a company, potentially buying in UK, it is another big hurdle potentially. I mean, that's something that, as I say, it's only a consultation at the moment. I think it's a bill at the moment, sorry, not a consultation. So that's just another thing that we're looking at for 2021. So although people are saying that there is a lot of activity in the pipeline, there are all these kind of risks, additional risks that corporates.
Yeah, look, I guess a lot of this is sensible. Any country would have to have that infrastructure in place. We've never, we haven't required it for a long time since being part of the EU. Now, if we're going to be kind of on our own again in the UK, you do need that, but that does cause the transition period where there's inevitably going to be uncertainty there.
Well, the thing is, we never had a formal system for it in the past. But my understanding is that, I mean, obviously there have been some high-profile cases since Theresa May brought in the kind of concept more formally for us. But as far back as, sort of, as I say, sort of 10, 15 years ago, I remember working on, there were some energy transactions, for example, where you heard about the government in the background just kind of saying, sorry, Gazprom, you can't do that. So I think that there's always been this, this idea, and that there have always been checks and balances, but I think this is going to be much more formal, and I do think it'll be much more at the forefront of people's minds.
Doesn't sound very British to me.
No,
yeah, I should be able to just have a chat behind the closed doors, and get everyone in their proper places
for a cup of tea.
Exactly. You mentioned earlier about doing deals from bedrooms. I had a conversation not long ago with a continental central bank in Europe, and they were talking about doing QE from back bedrooms. And so it kind of like, oh yeah, I guess everyone's working from home. So even central banks are affecting our monetary policy from back bedrooms. So it really is across the board there. So we talked a little bit about, or in fact, quite a lot about the outlook for next year. Anything else you want to add on to that, and expectations? In whether it's M&A deals or capital raising, or any thoughts there?
Yeah, well, I think everyone I speak to says that it's going to be a busy year next year. I think. We already spoke a bit about the kind of sectors that are more COVID-proof. And I think really the M&A markets and the ECM markets, actually, both markets are really following how the world has shifted with, post-COVID. There's a lot of excitement around the Deliveroo UK IPO, for example, that's coming. We also see any kind of sector that really has seen growth. Sometimes it's unusual ones. Things like, I had one private equity firm talking about how they're looking at coffee pods. A company that does coffee pods because everyone's making their coffee at home now. And areas like cold storage. Suddenly we need those. If you think about how our behaviour's shifted, that's really how people market. And private equity firms that I'm hearing that they're looking for things where they know that they feel that the market has shifted forever, like recruiting online. So I feel like those are the sectors that are going to be more durable. I think certainly in the US, people are looking at more, have been looking at companies that are kind of non-partisan as well, because obviously the shift in administrations is something that's on the forefront. And with the equity markets, the jury's out on how people will be looking at the UK post Brexit. There are some big deals in the pipeline in Europe, though. And another one that I haven't mentioned is like the Vodafone Towers deal. That's something they're looking at in Germany. So I think there's a lot to come. I think we'll be busy. I don't know if it'll be as busy as the third quarter because we haven't got that pent up demand now. And some of those paused deals obviously aren't necessarily going to come back. The other thing to bear in mind on the kind of recapitalisation side, because we can't forget these two very different strands of the market, is that the longer the pandemic continues, there is a possibility that those companies that refinanced and got themselves in shape in the summer, they may need to come back. If the pandemic continues for a long time, they may need to come back next year. And so that's just something else to bear in mind.
Yeah, there's no question that we haven't even begun to consider what the impact of all of the extra debt burden is on companies and individuals, and bad debts that inevitably are going to arise, and sort of the flow through from that. So I think there will be there just has to be some kind of an impact on that over time. You're talking about companies that are sort of secondary beneficiaries of the new changed world. And I was listening to a fund manager last week who was talking about how fairly early on in the pandemic, they bought shares in companies that were suppliers of packaging for Amazon. Because obviously, the guys making those cardboard boxes have had a heck of a year, because there's a lot more demand for them. So it is interesting to see the thinking going all the way down the supply chains, I guess, both on the long side, but also for securities lenders, on the short side as well, trying to identify that will lose out, not the obvious ones, but the secondary ones as well.
Absolutely.
So, Lucinda, listen, we've been chatting for a little while here. Anything we haven't covered that you think people should be keeping an eye out for and look for, markers or signs or trends of?
I think that pretty much covers it. I think the thing that more of a kind of US story this year has been SPACs, special purpose acquisition companies, because they've raised this huge amount of cash.
Can you just explain what a SPAC is, and sort of what the background to it is, who uses it, and what they're used for? I think that would be useful for people.
Well, I mean, it's essentially it's a bit like essentially what will happen is a firm will list what's a special purpose acquisition company, with the sole purpose of that entity is to make acquisitions. And so from a private company perspective, it's a really interesting way of accessing the capital markets without actually going through the IPO yourself. That would be why a private company would sell to a SPAC. And we've seen this year, we've seen a huge amount of cash raised by SPACs, and with some very familiar, famous managers. Bill Ackman, for example, he was probably the highest profile SPAC that was announced this year, and obviously these entities have to make acquisitions, and so I believe by the end of the first quarter they've raised about, I think it was around 34 billion. But obviously we haven't seen those acquisitions coming through, and the acquisitions aren't just US entities. Obviously there's some that are looking internationally as well. So I feel that we're in a kind of digestion phase of this kind of SPAC money. So that's just one other thing I think we should be looking out for. It was another key trend this year.
And just to be clear, so a lot of that money comes from private equity firms deploying money in a different way, or not?
Well, this is more, it's essentially it's an IPO. The SPACs kind of come to the market. That's how they raise money through the equity capital markets. So it's just the same as an IPO, really.
Okay, and it's a way to get sort of, as you say, the private company sort of bypassing the listing because the listing is actually with the SPAC as opposed to the underlying company.
Exactly. So once they buy the target company, then you might not. I mean, the thing is, the private company has to be ready to go public. They have to have all their records in order and accounting, etc. But it's a much, you take the risk out of the listing, if you see what I mean.
Interesting to see that. There's always some new innovation coming along, and I guess this year people have had more time to think up new ideas sitting in their back bedrooms.
Yeah, exactly. Who says you need to go into the office for creativity?
Well, I'm curious. The people that you talk to, do they see that their sort of office versus work from home balance will change? Is that a point of discussion?
Well, I think what everyone has been thinking about is, okay, we the initial period, everyone was like, well, this is fine, we can all work from home. But I do think, I made a joke about the creativity, but I do think that generally people recognise that you have innovation and creativity is really boosted by in-person interaction. The vice president of NICE actually mentioned this for them culturally. They like being able to get together, and they do feel this theme of creativity is comes from in-person contact. And I think we all recognise that we are very productive from home. I think most people think we're back 5 days, but when you do go in, maybe people are going a few days a week. You will be going in for more kind of. It's not just to show up to the office, if you see what I mean. It's more sort of creativity and innovation. And then on the flip side as well, people also think that in terms of travel, we probably don't need to do quite so much business travel. There's a lot that can be done through a Zoom call, whether it's a board meeting or, initial management presentation. So I do think people are recognising that they probably don't need to do quite so much travel, and they probably don't need to be in the office.
Yeah, I used to have the argument. At my last place, there were staff that loved working from home and couldn't see the benefit of being in the office. And I said, well, when you're in the office, do you ever get a coffee at the coffee machine? Now, I was one of the few people that actually drank from the coffee machine. Everyone else got good coffee. I was happy with just any coffee. But I think they got my point. They say, "Yeah, of course." And I said, "Do you ever sort of meet people while you're there?" Yeah, yeah. Do you talk to them? Yeah, of course I talk to them. What do you? And I said, "Do you ever come up with work things, or is it always just sort of private chatter?" And I said, "Well, of course we talk about work things." Oh, ever have any useful conversations there? Yeah, of course. What are you talking about? How do you do that when you're at home?
Exactly.
So I think, as you say, there's probably a blend. It also depends on jobs, I guess. There are jobs where it is really just about sort of a process, and you don't really need to have any sort of creativity in there. But most people in the whether trading or salespeople or customer service people, the reality is that's all about problem solving and innovation, and you can't do that in a silo working by yourself at home, I don't think.
Exactly. I'm looking forward to getting back.
Yeah, I was going to say for journalists, it must be because I guess you can still talk to people and everything, but you probably don't get the same degree of kind of sort of intimate detail that you would in a face to face conversation.
Well, I think you know the people, you know a number of people very well, so you can call them, and it's that's fine. But it is those chance encounters that we really miss. If you're at a conference and you meet someone randomly over coffee, that I think that's what we miss. I think journalists, just the same as everyone else, we miss those moments of serendipity.
True. Yeah. And conversations that start in one direction can often end in a different direction. So I guess that's it. Listen, Lucinda, thank you so much. I've learned a lot. It looks like we could have another interesting year ahead of us, hopefully with a little bit more stability and predictability. And that's always a good foundation for doing more business. So, look, I'd love to have you back again on a regular basis, so you can give us updates as markets develop. So hopefully, I can twist your arm into doing that again in future.
Sounds great. Thank you so much for having me.
Okay, thanks very much. And for listeners, I'll be back in a minute with my sort of summary thoughts from today's conversation. So thanks again, Lucinda, and I'll talk to you again soon, hopefully.
Thanks so much.
Before I get started with my wrap-up comments, let me suggest that if you like the program, please subscribe. And if you have already subscribed, please tell other people that might be interested. I'd also really appreciate if you could take the time to rate and review us at your podcast host site. I know that can be a pain, but it would make a big difference to us in being able to get guests to speak to you. So that's it for the pitch. Now let me get back to the episode wrap-up. Lucinda gave us a really interesting recap of what she described as a roller coaster year, and some of the stats and information and stories she gave us really reflected that, I think, perfectly. Particularly this kind of roller coaster of huge and then nothing and then huge relates to M&A. Going into 2020, everyone expected a big year, and we were out of the blocks really quickly before COVID hit and other potential action really just came to a standstill. She described how firms turned to thinking about how they would survive the lockdowns that were obviously happening around the world, and trying to determine whether they could survive or whether they needed and could raise extra capital. Then over time, she described how deal makers became more comfortable operating within the confines of the pandemic, and deal flow started to pick up and transactions were getting done again. However, Lucinda noted that it very much became a bifurcated market, with companies that weren't affected by the pandemic or indeed may even have had some benefits, and transactions resumed involving those companies first. On the other hand, companies that were suffering may have been involved in distressed M&A deals just to survive. She also gave us some perspective that in recent years, the trend has been more towards going private, and Lucinda felt that this year, corporations in the US and the UK started to appreciate the equity capital markets again, and even how the FCA rule changes help support capital raising in the UK. One really key item to note is her mention of the size of many of the deals this year, which has just been huge. At the other end, though, she noted that there were bottom fishing and opportunistic deals that were also pretty prevalent. Now, probably Brexit got mentioned more in this episode than any of the other 20 plus that I've done. But of course, it has to be part of any future discussion, particularly in this kind of a space. And frankly, some of the things that Lucinda mentioned were a bit of a concern to me, as it looks like it might just be harder to get deals done in the UK in future because there's uncertainty and a new engagement, or shall I call it potential interference from regulators in the UK. The UK has always been a great place to do business, and I hope that post-Brexit that remains to be the case, but time will tell. We talked about SPACs, the newest popular four-letter acronym in the business, and Lucinda corrected my understanding on these important influences on the market. Finally, we wrapped up on a reflection of life under lockdown, and Lucinda highlighted the chance encounters and engagements with colleagues, contacts, and peers that sometimes just kind of pop up spontaneously. And, these are more likely to happen over a cup of coffee than an ad hoc Zoom call. From what she said, it looks like we have a good 2021 ahead of us, and we'll definitely invite Lucinda back to update us again and again. As always, we encourage you to share topics or guests that you'd like to hear from, so drop me a line at roy@peerpoint.info. Of course, all of our contact details and links are in the show notes, as well as those to Lucinda and her company and the various products that they offer. We provide a lot of free securities content, which you can access at our website, www.peerpoint.info. We're active on LinkedIn and Facebook as Peerpoint Financial Consulting, and on Twitter and Instagram as Peerpoint FC. I'm Roy Zimmerhansl. This has been Peerpoint Perspectives, the art of securities finance, and I look forward to catching you next time.